There we go. Hey, how are you?
Hey, what's up, Leslie? Doing
I,
awesome. How are you?
yeah, things are looking pretty good. I just want to introduce you really quick. This is Two Mullins of My Mortgage here in Jacksonville, Florida. And we're going to talk a little bit about rates and some really exciting, really fantastic, not even first-time home buyer programs. They're like just home buyer programs that you
Home
can,
buyer program. Yeah, some
yeah.
flexibility, some help for the buyer.
Oh,
And what's
help for the buyer. That sounds really good these days.
absolutely, yeah. Well, there's a lot of things that are, the market is what the market is, and rates have done what they've done. So we've got to find some ways in there to look and see what you can do to make buying a little bit easier, to make it a little bit less expensive, to make it a little bit lighter on the pocket. So we've got some things like that. We know what we've got in terms of interest rates and what's going on there and what's affecting rates. Today is the same thing that's always been affecting rates, and what's going on is that we're in a market that's trying to deal with inflation, inflation of goods and services. As that improves, interest rates for mortgages will also improve. But that's been one of the biggest things that's driven rates up over the last year and a half now. It was April of 2022 where the Federal Reserve started making adjustments that they weren't making during the pandemic to kind of catch the federal funds up with where inflation was. And
So right at
inflation
2
had
years ago.
rampant during that time, and we started catching up with rates, and that's when rates started to increase. Was about 2 years ago.
And where were
So
we? Do you know where we were then?
yeah,
Just off
if
the
you
top of
go
your head,
back,
roughly.
if you fast forward, if you rewind back to April of 2022, interest rates were like in the low fours.
Okay.
They kind of started to move up from lower levels in the threes, and it kind of started to touch the low fours. And then from there, just really started to increase quickly over the next, I mean, essentially 18 months. And so we've kind of been in that same place. I feel like we're in the same place now that we were this time last year and a little bit before that. With still inflation being the big driver, the bond market has gotten a little crazy with that. There's been lower demand for mortgage-backed securities, and what that means is there's less investors buying mortgages. So that puts pressure on the rate to increase. And part of the reason for that is because of perceived prepayment risk. An investor would think that if I buy this mortgage that has an interest rate of 7.25% or 7.5%, that the holder of the mortgage is going to restructure the loan when the market improves, when they get the opportunity, right? And so that effectively terminates the investment when they do that. And so there's not as much desire to go in that direction if you're an institutional investor. And that's part of the reason that rates are still kind of where they are and why they haven't come down. Just a lack of demand in the secondary market. That's a big part of it too. We don't talk
Okay.
about a lot.
But then that would imply, by the way, that would imply that these investors think those rates are going to go down significantly enough to cause these people, to cause all these people at the, we're at 7% roughly right now.
Yeah,
Is
well,
that
yeah, I
about where
think
we are?
that's a yes, that means that the thought is that if rates are going to decrease on a shorter horizon, that as an investor, I'm not going to be there to see this investment through
Right,
for
because
a
people,
longer period of
all of
time.
those people are going to refi out of that rate and out of their 7% and into their 5% rate.
Right.
Presumably, I'm making up numbers, obviously. Um,
Sure. Yeah. So that's what I mean by prepayment risk. The loan gets paid off, and then the investment just doesn't quite see
Interesting.
its full potential. So that's a part of it. The Federal Reserve controls monetary policy. They're monitoring inflation, and really what the Federal Reserve does in controlling the federal funds rate is really controlling that part of it, and what reacts to it is the bond market, and that's where mortgage rates are derived from. When we
Okay.
look at what bond prices are doing versus their yield, so that's been a big thing. And the last thing really is like one of the bigger elephants in the room that again we don't talk about is the debt. The national debt right now is at 34 trillion and counting. And that's money that the country as a whole is in debt to mostly foreign investors. And that number has gone up substantially. It hasn't gone down in quite some time. And it does put a lot of pressure also on the bond markets. That's what's going on. The Treasury basically every so often is auctioning bonds off, billions and billions of dollars of long-term bonds, 30-year bonds and 10-year bonds, 5-year, 20-year paper, and foreign governments are buying that. And sometimes when those auctions aren't performing as well as they'd like, they have to increase the yield, which lowers the price to get the appetite there. So that's not good for the bond market. And that's been one of the patterns that we've kind of been in for a while with inflation. So I think as that continues to improve, we'll see rates improve. And it has happened. Rates have come back down. They pulled down slightly from the higher marks in the sevens. I'd say like high sixes is what I'd expect today with reasonable credit and reasonable down payment for an owner-occupied property. I think that's a fair.
Okay. And let's be clear, today being March 27th of 2024, just, if you're watching this later, if you're watching this April 27th of 2024, that could be a very different number.
Right.
just throwing it out there.
Yep. No, for sure. So what can we do to help? Well, one of the most popular buyer programs for owner-occupied buyers is FHA. FHA loans are great. They're very flexible for first-time buyers and repeat buyers, but you have to be buying a property that you're going to live in as your primary residence. The loans are insured through HUD, so there's some protection for the lender that helps on the interest rate side. And there's also that also helps in terms of the down payment percentage that the buyer has to make. You can purchase using an FHA loan with as little as 3.5% down. We have a new product right now that will actually help the buyer reduce their out-of-pocket expense. And what that does is instead of the buyer coming out of pocket for the 3.5% down payment, they can actually finance that. So it's FHA now allowing up to 100% financing.
I mean, that's unbelievable.
Taking this a 3.5% second mortgage, which is relatively small percentage of your overall purchase price. So that comes with a very small secondary payment. The benefit, though, for the buyer is that it's going to reduce their out-of-pocket expense. So just to talk about that in terms of real numbers, if someone's purchasing a home for $350,000, 3.5% savings out of pocket is $12,250. Money that you can use to then pay your closing costs or pay your moving expenses, that sort of thing. So again,
repaint, put in new flooring. I mean, $12,000 can go a pretty long way. Not as long as it, as it used to, but pretty long way.
Yeah, absolutely. Yeah. Still in your pocket, right? Which is a good place for it.
Mm-hmm. Yeah.
So that's an option to help, just to help reduce your out of pocket.
Yeah, that is absolutely amazing. So, okay. So we think, I don't know. And I'm asking, I hate to ask the crystal ball questions too.
Right.
As we come into what I think is going to be a fairly volatile summer for a lot of reasons that we can talk about later when those reasons are clear to everybody, when it's been discussed better, when it's been determined better. But I mean, it's going to be a fairly volatile summer. However, are we thinking that, I mean, coming into an election year, historically, interest rates come down during an election year. And I'm not a bond market, I don't follow all that stuff, but I do follow history, fairly closely. Right. And so that is what we tend to see. So now we're looking at interest rates coming down, but we're still, so when I looked this morning, we had about 7,800 properties on the Northeast Florida MLS active, right? And those are active properties. That's still far below what we would need to be to see an even market, especially given how many people are moving into our area every month. I mean, it's, it's just massive. Thank goodness we are actually seeing investments being made in multifamily housing, like apartment complexes and things like that, because 5 years ago, I didn't have anywhere for these people to go. It was ridiculous. It's easing a little bit. However, as interest rates go down, you have programs like what you're talking about, which, I mean, no money down except your closing costs. And you can ask for closing cost assistance in an FHA transaction. So really being able to get into a property for very, very little money, cash out of pocket. Right. I think we're going to see, we have seen our inventory really ticking up still for the last few months, which we're getting ready to get into that time of year where we see it to start to tick back down because the buying season is coming up.
Right.
I really think that's what we're going to see. And I really think as those interest rates go down, we're going to, and we have programs that are getting people in homes and coming into a volatile summer, and all of those things I think are going to converge in. We're going to start seeing more, and we're still seeing houses with multiple offers and things, but I think we're going to start seeing more multiple offers, which of course then leads housing prices to go up.
Right.
It's this cycle that we've been in, that we've all seen for the last, I want to say 4 years, but it's not. It's really 5 years that we've really seen this strong market, and we're holding steady. And we'll see how this summer goes, but for the next few months at least, it looks like we're going to hold pretty steady. I think inventory wise, I don't think we're going to see a glut of. I don't think people that are comfortable in their homes are going to suddenly break out and sell. And in fact, they're not. I mean, people tend to, in uncertainty, stand still. Right. So I don't think we're going to see a glut of homes coming on the market.
Right. Yeah. And I don't, the same thing with new construction, right? Sometimes that can help fill the void for
Mhm.
inventory. But it doesn't seem to be keeping up with demand right now. The reality is that people are relocating here still,
Right.
from all over the country for a number of reasons. And that's still keeping a lot of demand on the housing supply that's there. And even though it's ticking up, it has increased some, it's still not at a place to where it's matching the demand.
The demand. Right. We're still very much in a seller's market. And there's a lot of, and I see a lot of articles and things coming out right now about how, about how real estate in Florida is tanking. I think I saw 3 or 4 articles about that last week, which was ridiculous because on its face, obviously that's a lot of clickbait, because one, it's not. Two, there are some conversations that you can have that affect a lot of Florida, but don't necessarily affect Northeast Florida. And one of those is the condos, right? In South Florida, you tend to have a higher percentage of condos. And condos are definitely in South Florida slowing down. That condo buyer is slowing down. And it's an insurance issue. We had that horrible, horrible collapse of the condo building in Surfside, and a massive overcorrection of the legislature coming in and demanding that every building within 5 miles of the beach over 20 years old has a full structural report, which isn't necessarily a bad thing, but the implementation of it is difficult, right? Because you've got the timelines are so tight. You've got I can't even remember the millions of condo buildings that fall into this, because you figure a 5 mile perimeter around the state of Florida on a peninsula is a lot of condos.
Be a few buildings.
Yeah. So anyway, but you've got a bigger percentage of them there. When people talk about the Florida real estate market, they're not talking about Northeast Florida. Northeast Florida is its own animal. Tampa is different. Tampa and Orlando are different from Miami and the South Florida stuff. So we're starting to see, we're getting into that news cycle, especially with everything going on right now, that everybody wants to say the sky is falling. The reality is, as I look at numbers every week, I know you look at your numbers every week, the sky is not falling. Our market, while we have things that are sitting on the market for maybe 30 days, maybe 45 days right now, in 2017, that was 90 to 120 days, and that was normal. That is actually a normal number. 30 to 45 days is still really, really quick market. It just is a different shift from what we were used to for a prolonged period of time.
Yeah. So yeah, it'll be interesting to see, this being an election year, and ironically, the forecast is that, the Federal Reserve has already signaled that they intend at some point, we don't know when, to start reducing interest rates, federal funds rate. That will have some positive effect on the bond market, you think. But sometimes it's hard to say because the markets like to jump the gun, and the markets have been responding favorably so far on the Federal Reserve just indicating that they intend to cut rates. So some argue that those rate cuts could be already priced into the bond market. How many, we don't know. but there's other economic activity that's still going to happen between now and then. Between now and then being the end of the year, now being the first quarter still, that is going to really, I think, determine where we end the year, higher or lower. So the forecast basically, they basically ran the forecast back for last year, that interest rates were going to decline over the course of the year. It just didn't really happen. We got to the end of the year, we got to Thanksgiving, and things had really increased quite a bit and started to tail off at the end of the year, but we're back in this. We basically did a circle, and we're started this year back where we essentially started last. So to be seen in terms of where we end, but the forecast is indicating that those things will happen. So that's my hope.
Those interest rates will go down, which will cause, and the hard part is right now everybody is excited when we say interest rates go down, but if interest rates go down, then buyers start to flood the market because they want to take advantage of that opportunity. Everybody wants to time, and I do love this because everybody wants to time the market. And the reality is when you're buying and selling a home, it's your timing is what your timing is.
Right.
Nobody has a crystal ball. Nobody really knows. But if you're trying to time the market on rate, you are likely missing your opportunity on price because our prices are not coming down significantly. We're seeing them level off. We're not seeing the price increases that we have seen over the last few years, and that's a good thing. I am not complaining. If you bought your house 5 years ago, you are sitting in an amazing equity position. If you want to downsize or upsize or do whatever, you're in a really good position to do it. Your house is gonna move. You are starting to see more inventory come on the market. So right now you're starting to see more options of if you're going to move, where are you going to go? You got to have a place to go. And it's like those pieces are all falling together fairly well. And that's great. But if you're trying to time the market and you think you're going to time the interest rate, when you throw a bunch more people into that mix, now it gets a little bit harder. So that's a long walk around that. I love it. Well, so we talked about what we think interest rates are going to do. So, all right, so crystal ball, the Fed, I think it's very interesting when you say that just talking about it seems to be enough. And I know I've noticed that as well. It's like, yeah, they said they were going to do this. So all of a sudden, this happened in the stock market, or, I find that amazing that your institutional investors are jumping the gun that quickly on information that says we might.
Analyzing every word of their statements and every word of the press conference to see what indications that we can get in terms of making decisions financially. Yeah. So a lot of the time those things get priced in ahead of schedule. And when tides turn, before that happens, you can see fluctuations in the market. So yeah, the markets have been very volatile during this time over the last 18 months. And that's a big part of the reason why. There's speculation, then there's inflation, then economic data comes out. We've got the reality. And if the reality isn't in line with the projection or what the estimates were, then we've got to go back to the drawing board. So we see these swings. And yeah, like you said, it's nice when we can catch it on the right side of the swing, when we're on the right side of volatility, meaning that rates are declining rapidly. We've made changes have been made that have caused the market to come down. And if you're in a position where you're submitting offers during that time, or you're negotiating with a seller, that's not a bad time for to be doing that, but you just can't control that part of it. So that's why there's you have interest rate lock protection to help with that. Once you're under contract, when you've identified a property and you're under contract, you can lock an interest rate for short of a period of time as 15 days right now, and then up to about 75 or 90 days sometimes in some situations. So that's what we look at, and we're trying to make the best decision on where the market's at right now versus where it's heading. Longer term things right now coming in the door, I think you have a bit of an opportunity to look at the market and maybe make your decision down the road a little bit and punt for a few days down the road to come back and still make a solid decision. If someone's walking in the door now and it's shorter term, we're closing in 15, 20, 25 days or so. It's always a good opportunity to, lock loans where you can and get out of that interest rate risk and just not have that to deal with.
Yeah, because things that, like you're saying, as you're kind of saying, let me form a sentence here. Things are still volatile. Like, the market of the moment is the market of the moment, and taking advantage of the situation that you're in is probably the best. Sorry, I have furry terrorists, like really curious about what we're doing. The market, you gotta deal with the market that you're in, because there is too much volatility and there's too much uncertainty to really know what tomorrow is going to bring.
Right.
What we don't think tomorrow is going to bring is a complete and total collapse of the housing market. And I have had conversations recently where people are moving from other areas going, well, my area was cheaper than this, so obviously you're overpriced here, so therefore I'm going to rent. I literally had someone wanting to rent for $5,000 a month while they waited until our prices came down.
Wow. Yeah.
And I said, okay.
Yes. You can only control so much,
I
right?
can only do so much. Exactly. Yeah. And while we're kind of on it, while I'm still sort of on it, condos. Are you seeing, because I am getting questions about this, are you seeing people struggling more to finance condos? Are we seeing those things coming into play that are becoming an issue for you?
Their condos are always a case by case. I feel like, because you've got to look at the individual. You've got to look at the bank looks at a number of things, right, when determining how we're going to handle a condo. So we're going to look at what the occupancy is. It's going to be owner occupied. Is it going to be a secondary residence? Is it going to be an investor? Is it what type of loan? What loan program? Is it going to be conventional? Is it FHA? Is it VA? And then we have to go and we look and see, is the association currently approved to accept financing for any of those or all of them or none of them. Mm-hmm. And a lot of the time what we end up having to do is a full review. And that's where we have to have a condo questionnaire completed by the condo association, ask a lot of basic questions in terms of the units, the number of units, occupancy, vacancy, owner occupied concentration versus investor saturation, and looking at the financials of the association, the insurance, all of these things being taken into consideration for the project, and stacking that against what the requirements are for the investor, whether it's Fannie Mae or HUD for FHA or whatever else. So it's always that. It's always been that. Are you
seeing insurance be an issue? Because I know a lot of the communities are you seeing insurance be an issue? Are we seeing those buildings be underinsured for the investor?
I've seen some liability insurance concerns with different associations. Yes, over the last.
I love how you say that.
Yeah.
Yeah, I love that you're so cautiously saying it, which means that these associations, in order, because they are struggling, I know that there's a lot of insurers in Florida, and we know that homeowners insurance is an issue in Florida. I know that there are a lot of companies that just don't even have any interest when these condo associations go out to bid. They're not even interested in bidding on it. The insurance companies, they're not even interested in doing it. So now they're underinsured. Occasionally.
Yes, occasionally. Right. And I have seen that, where you've had insurance concerns over the amount of coverage that is there for the association. That's got to be in line with what the investors need, so we can see what it is and see what they have in place. And if that's something that you can work through, that's great. If it's there and the numbers are in line the way they're supposed to be, that's obviously favorable. You can get that set up for an approval. And if it's not, then you've got to have a conversation there. And that can be something that obviously the prospective homeowner would want to know, because that's an association that they're going to be paying into. You want to make sure, obviously, that the insurance is there in the event that it needed to be used. So
yeah,
help influence your decision over whether you want to live in a community or buy that property or not.
Yeah, absolutely. And and I'm not talking condos. I love condos. Condos are great. I live in a condo. I don't want to take care of a yard. I love, it's everybody's got their own. everybody's got their own lifestyle for it, you know? So I'm not dogging condos. I think condos right now are struggling, which could actually, and here's what we know. Here's fundamentally what we know. Condos right now are struggling for a lot of reasons. Yes, they are selling. It is not, you know, we are not desperately trying to offload condos. However, I think pricing could get over the next couple of years as we work out some of the things with dealing with the structural letters and all of that. I think pricing could get softer for condos than it is for single family homes, which I do actually believe can create an opportunity for buyers because it will work its way out. The
Right.
insurers will figure out that there's too much business, there's too much opportunity. The insurers will figure out how to make sure that how to make sure that they are insuring these properties. All of that's going to work its way out. And so if there is uncertainty there, it could be an opportunity for somebody wanting, if you want to time the market, that may be where you want to be looking.
Right. Kind of let it play out, see where it lands here over the next couple of years.
There you go. Yeah.
And yeah.
And it'll get there. We know it'll get there. It's just gonna drive us crazy getting there.
Matter of when, right? Yeah.
I know, right? Well, thank you so much. This was awesome. Is there
Always
anything else we want to talk about? Anything else I missed? We've got about 5 more minutes left on the Zoom if there's anything else that we missed.
Well, we got some good information to help reduce out-of-pocket costs with FHA.
I'm so excited about that program. That's amazing.
That is great. There's conventional down payment assistance still available throughout Florida. Doesn't matter where in the state, as long as it's going to be owner occupied. As long as it's for first-time home buyers, meaning that you haven't owned your primary residence in the most recent 3 years, you can qualify for a minimum of $10,000 in down payment and closing cost assistance, and potentially up to much more depending on the purchase price. So that is very good news. To just touch on that FHA 100% financing program one more time, a couple of good pieces to add to that. And you said it earlier, I didn't really do a good job of emphasizing this, but that's not a program that's just restricted to first-time buyers. This is anytime buyers. You can be a move-up buyer. You can have owned your home or currently own multiple properties. That doesn't matter. So it's anytime. There's also no income restrictions on that. Oftentimes, the out-of-pocket savings programs come with limitations in terms of what you can earn. This doesn't have any of that. There are no income restrictions. All of the underwriting is standard FHA, which means the maximum loan amount here in our market this year is about $498,000 and under. So you've got to finance that amount and under. Primary residence, you don't have to be a first-time buyer. And the pricing and the interest rate for it, very comparable to what you'd expect to see if you were just pricing a standard FHA loan. So it's not one of those things where you're reducing your out-of-pocket expense at the expense of, a less favorable situation in another part of the loan. The financing all comes together and just helps to make sense and help reduce, again, the out-of-pocket expense. That's the biggest benefit.
I love that. That's fantastic. Well, awesome. Well, I look forward to doing a few of those deals with you. I think we will here shortly, because that is just too good. I love it.
A good one. Yeah, FHA is there and lots of flexibility there. So hopefully, as rates continue to improve, things like that will be there again to help the buyer keep it moving forward.
I love it. Awesome. Well, thank you so much. And we will catch up again soon.
Bye-bye.
Bye.